Thanks for joining us on The Close today. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Canada's Financial Consumer Agency is fining the Bank of Montreal a $4 million penalty for overcharging customers on fees that should have been waived. It's related to discounted bank accounts for newcomers, medical and dental students, and Indigenous clients. The watchdog says more than 100,000 customers were impacted between 2010 and 2024. Shares of Canadian Pacific Kansas City edging higher today. The rail operator set a new record for shipping Canadian grain and grain products in January, both by amount and carload. CPKC says an effective crop year, winter planning, and demand forecasting helped it prepare for the month. Shares of Palantir are rallying today. That's after a fourth quarter profit and sales for the tech company beat expectations. Revenue was boosted by a surge in domestic commercial operations, as well as Palantir's work with the U.S. government. The company's full-year revenue outlook also came in higher than analysts had been expecting. PepsiCo shares higher today after topping fourth quarter revenue expectations. The quarter benefited from robust demand for its pop in international markets, as well as strength in its low-sugar beverages in the U.S. Pepsi says it's cutting prices by as much as 15% in some of its key brands, including Lay's and Doritos, just to make things more affordable. An up and down day on the market so far. The TSX Composite now just 100 points up, or just short of that, to 32,286. Let's move to the U.S. markets. And the S&P down 70 points today, down 1%. The Dow Jones, a 195-point drop on the day, 0.4%. And the NASDAQ has a 1.74 percentage drop, 409 points down. Gold and silver rebounding today after that historic collapse. Our next guest says with continued geopolitical tension, we should continue to see precious metals perform well. Let's go to Paul Harris, portfolio manager at Harris Douglas Asset Management. Paul, thanks for joining us. What's your outlook for gold and silver for the year? Did you anticipate this correction?
No, so we don't own any gold stocks or silver stocks. That's one thing. But I think gold has always kind of been this representative of if the world is sort of in a difficult situation, geopolitically or economically. And I think that's what you're seeing today. Is you're seeing this sort of continued geopolitical issues that are facing the world globally as the U.S. sort of pulls away from alliances, et cetera. And I think you're also seeing sort of the general kind of the U.S. administration acting in a more chaotic fashion about a lot of things, right? So I think that's really what's pushing up gold, and then obviously silver gets the benefit of all those things. The other thing, obviously, is the kind of continued weakness of the U.S. dollar, which has helped these commodities, right? So I think that as long as we see this a world we're living in where there's such turmoil, I think people will certainly want to move into gold and other precious metals. I mean, I think the other issue, what happened on the day it fell a lot, was that they had a new Fed governor, and I think the issue with that is that most times when a new Fed governor comes in, they kind of do policies and procedures of how everything is run and try to kind of figure out how they want to envision the Fed being run. And I think that the new gentleman has a very different vision of what the Fed is. I think he felt that their mandate had become too wide, that they were, quantitative easing, although it's a necessary evil to be used in difficult times, was not pulled back fast enough. And so the Fed balance sheet became quite large. And so I think there's a lot of that talk about how he's going to kind of run the Fed. That doesn't mean he can drop interest rates as Donald Trump wants him to do, but it may mean that the Fed is viewed very differently from a perspective of how we move forward with when there's a big problem in financial markets, et cetera, or how we kind of envision the Fed acting in certain ways in different times, right? So I think that's kind of all those things were kind of a shock to the market when he came, especially the precious metals. And the last thing I would say is that these things have run up a lot. So, kind of healthy pullbacks, what I think people would say in a bull market in commodities, is an important thing.
Okay, let's get to Palantir reporting earnings. Why do you think it's seeing the strength it's seeing when other software companies really aren't? Is it just their government contracts that they rely on?
Yeah, it seems to me that way, right? I mean, well, one of the things, they beat revenue, they beat EPS, and then also they gave very positive guidance going forward. So I think that's kind of helped out. I mean, you've kind of not seen that on the software side with some other these kind of tech companies where you've not seen them sort of give kind of meaningful, kind of positive outlook for the next several quarters, right? So I think that's helped out Palantir a lot. A lot of their business presently comes from the government, right, and governments, and so I think that's really kind of, and especially in the world we're living in today, I think they benefit from that. So I think that's what's really helping the company out. But it is one of the most expensive stocks in the S&P 500 today. So I think that you have to be cautious about when you're buying something at these multiples, whether they're going to be able to achieve that valuation over the long term.
Okay, let's talk about Meta, which did report earnings, Amazon and Alphabet to come. What are you looking for? What are you watching in the metrics for the tech companies?
Well, I think from Alphabet and Amazon, I think there's a couple of things you want to look for. The first thing is that on the advertising side, because they're both big advertising companies, do they show the same kind of metrics that Meta shows? Are you seeing the use of AI improve outcomes on the advertising side for these companies, like you saw with Meta, right? So I think that Meta, out of all the kind of tech companies, it can achieve that a lot faster because they're kind of dealing with retail clients. So would you see that with Google? Do you see it with Amazon, which has a very large today has grown their advertising business quite a bit. I think the second thing you want to see is their cloud business for both these companies. They're very big in cloud. Amazon's number one, Microsoft's number two, Google arguably is number three. Are you seeing sort of their continued growth in cloud, like you saw with Microsoft? But Microsoft also came out and said that they've seen some restrictions on their ability to grow quicker. So I want to make sure that you're seeing that there is growth, but are they seeing the same issues with Microsoft is seeing, or are they in a different thing and a different part of that? Are they seeing very different metrics? And the last thing I would say is that everybody's looking at all their massive capex spend, right? So I think that what is the for the next couple of quarters, what do they see as their spend? Are they seeing a reduction in that spending? And I think the other thing that people are worried about with a lot of these companies is that spend has gotten to be so large that it's affecting their balance sheets in many ways. And so I think what people want to see is that how they manage revenue/cost. You saw with Amazon that they're laying off about 16,000 people. And that's partly because they're using AI more effectively within their firm to offset some of the kind of use of technology. They're using AI to bring down the number of employees that they need to work on a lot of projects. So I think you're seeing the use of AI internally within these companies. The offset is whether they can offset that enough to, on the CapEx spend side and have a much better revenue to cost ratio, which I think people are really worried about.
All right, Paul Harris, got to leave it there. Thanks for joining us. Paul's portfolio manager, Harris Douglas Asset Management. Coming up, AI startup Anthropic now releasing a tool designed to automate some legal work. We'll talk about the fallout of that when we come back. There has been a sharp sell-off across data and legal services stocks today after Anthropic released a new corporate productivity tool. For more, we were joined by Rudy DeFelice, global head of Harbor Labs.
There's recognition that the foundational language models present a long-term threat to some of the SaaS companies and traditional research companies. Today, I think premier legal organizations wouldn't swap their enterprise-wide tools for language models for most applications, but I think the market's starting to see that day is coming when the challenge is going to be a little bit more significant.
Okay, so let's backpedal a bit. For people who are not within this industry, what does the Anthropic legal plugin actually add to the market? What is it?
Well, Anthropic has enterprise subscriptions, and they have this co-work environment in there. And within the co-work environment, they have certain domains that they've built specific workflows. So they have finance, marketing, sales. They've just added a legal plugin. And what the legal plugin does is it allows people to do legal activities on the foundational model of Claude. So, if someone has a contract they want summarized, or they want to extract certain fields from it, or they have some workflow where they want something to introduce a process that has, kind of legal resonance, they're able to do that now.
So interesting.
And that's what many of the traditional tools, and even some of the new AI-specific tools, specifically Harvey and Legora, which have been getting a lot of news lately, they've developed really sophisticated products in this area, which have tremendous market capitalizations, and they're, to some extent, I think, running behind those products.
I mean, it's been interesting to see the reaction to this introduction of this tool today, right? Like, there's a number of Canadian tech companies that are down because of this, but also Thomson Reuters, for example. We were watching this company today. It's down, like, last I checked, 19%. Does this just show how important competition is within these different companies?
Yes, the legal technology space was considered a little bit of a backwater in the broader technology world, but because of AI, which is so specific to what legal organizations tend to do, what we do in legal is digest large amounts of information, reason, and create output, and LLMs are very good at this. So there's been a lot of focus on what the impact on the industry is going to be from language models. Yeah, it's tremendous that TR is down, as you said, up to 19%. Seems like an overreaction to me. There was also kind of an analyst warning, so I think those two things in combination probably led to that. But LexisNexis, which is a competitor, their parent company's down somewhere in the mid-teens, and Wolters Kluwer, one of the other big three research companies, is also down in double digits. So it's a pretty significant movement in a single day. I believe it's a bit of an overreaction, but I think it's a signal that a change is coming in the legal space, and that the traditional companies are going to have to evolve.
So interesting. I mean, if you think it's an overreaction, then obviously we'll see a bit of a correction here with some of these companies, I'm sure.
Yeah, it's a tremendous drop for one day, and nothing really fundamentally has happened to these companies other than what the future might hold. And I think there's too much unwritten, too much changing too fast to predict that kind of drop in the enterprise value of these companies.
So why is Anthropic doing this? Like, as you say, is this just the future of this industry?
Yeah, I think the foundational legal models, OpenAI, Anthropic, they recognize that they've got a tremendous core product, and that the revenue models are going to exist in the enterprise applications of those models, kind of on the periphery of what the fundamental language model does. So they want business users to have some specific solutions that relate to them. So this co-work environment, which Anthropic charges for, they're making it more compelling by adding the kind of business functions that most enterprises tend to do. Now, I don't think that they feel that this is going to put the Harveys and Legoras out of business, because they build very elegant, specific things for premier legal organizations. But for general enterprise users, commercial users, smaller organizations, these tools are super valuable, and I think it locks people into the platforms.
You touched on it.
Intelligence is being commodified. So to the extent we could make this legal intelligence free for smaller organizations, it probably has a societal good as well as a real kind of enterprise value for Anthropic.
You touched on it, but I'm wondering in our last minute if you could just explain like what this means for users and how people will be able to actually use it.
Yeah, so I think a general commercial user who is involved in a business deal can first draft of a contract. If they received the contract from somebody else, they can have it analyzed against a risk profile that they have to maintain. They can create first drafts of things that have kind of legal flavor in ways they couldn't before.
Rudy DeFelice is global head of Harbor Labs. Coming up, David Rosenberg says Canada's economy is on life support. We hear from him when we come back. After Canada's economy shrank in 2 of the last 3 quarters, David Rosenberg says we should be on recession watch this year. We got more from him. He's the founder and president of Rosenberg Research.
The bank has cut the policy rate by 275 basis points. Of course, the only people that borrow at the overnight rate are the banks and nobody borrows at that rate, and other interest rates haven't fallen nearly as much. When I see the proof of the pudding's in the eating, question is, since the Bank of Canada started cutting interest rates in the spring of 2024, what's the Canadian economy done over this time span? And it's barely better than a 1% annualized growth performance. And although the population trends have slowed with the immigration rule changes, real per capita GDP in Canada is still declining. That has not been arrested. So, yeah, I would completely agree that the Bank of Canada probably never should have gone to 5% to begin with. So we came off rates that were very elevated. But it's clear to me, unless the policy lags are just a lot longer this time around, that if this is what 275 basis points of Bank of Canada rate cuts delivers, the grand total of a 1% growth economy, the next question is that all you get?
This kind of reminds me of the interest rate policy in the wake of the 2007, 2008 banking crisis. Low interest rates didn't seem to stimulate growth then at all.
Well, it's, Tiff Macklem wasn't wrong that a lot of the, call it structural issues with the economy are developments that transcend the power of the central bank. But at the same time, if I were in Ottawa and I were in his shoes, I would be doing all I possibly can. Inflation in this country is not really an issue. Virtually every underlying inflation measure is comfortably within the Bank of Canada's comfort zone. And the economy is growing below potential. And the Bank of Canada's own forecast, when you dig through the details, is for this disinflationary output gap to be with us, not just this year, but through the end of 2027. So I'm a little surprised that the Bank of Canada is taking such a strident approach. I do think that they will be compelled to cut rates further, even from this egregiously low interest rate. And I think the Canadian dollar, which I had been bullish on tactically, is going to come under some renewed downward pressure at the same time, because there's a case to be made that the Fed probably doesn't do anything at all, at least through the first half of the year.
We have a chart from you guys just showing real GDP year-over-year percent change going back to 2022, and it shows a relentless decline. Yeah, we're running in growth, I should say. Sorry, go on. Sorry, David. Yes, go ahead.
Well, yeah, we got the monthly data late last week. The GDP trend is running at roughly 1%. The fourth quarter sequentially, as you mentioned in your preliminary remarks, is probably going to be fractionally negative. And I'm trying to look around for, what the source of vitality is going to be. I'm really quite surprised that most Bay Street economists have an inflation view, or at least some of them do, and that everything's going to be fine and dandy because we're going to get a modest amount of fiscal stimulus. I think this is still very largely a show-me situation. I'm looking at just a broad array of indicators, and it's quite striking. You would think that of all the sectors that would benefit from what the Bank of Canada has done, you think would be the housing sector. But if you look over the past year, residential construction expenditures are flat as a beaver tail. Home prices, everybody was telling me back in the summer of 2024, when the Bank of Canada started to cut interest rates, people were saying to me, oh, just wait, they're going to reignite renewed rounds of housing inflation. None of that has happened. In fact, home prices in Canada nationwide have either been flat or negative sequentially for 10 months in a row and are running negative 2% year over year. And then, we were hoping up until recently that there was some sort of detente with Donald Trump, that his relations with Mark Carney were starting to improve. Well, of course, we can throw that in the waste paper basket right now. But, you're taking a look at manufacturing activity in Canada, even with what would be deemed a competitive exchange rate. and red-hot U.S. economic growth that you'd think would be pulling in Canadian shipments, manufacturing is actually down 5% year over year. Like, you're talking about a recession. Well, you have a recession already in the manufacturing sector. And there's no real thrust in terms of retail sales. When you adjust for whatever inflation there is at the retail level, there's practically no growth there either. And that, of course, is very interest sensitive. So it comes back down to, your view on the Canadian dollar is basically if manufacturing and exports, it's incredible. Exports are lower today, the level of exports, than they were in the spring of 2022. And they're also running negative year on year.
David Rosenberg is the founder and president of Rosenberg Research. The port of Churchill, located in Manitoba on the Hudson's Bay, is North America's only deep-water Arctic seaport with direct rail access. But the future of the port is not set in stone. Here's CTV's Alison Bamford.
Those who've lived in Churchill, Manitoba long enough remember the days of a bustling port.
Churchill and the port are pretty synonymous with each other.
Joe Stover worked there for 10 years at the tail end of its glory days.
That was going to be my retirement job.
The port currently operates just 4 months of the year. Ottawa has flagged it as a transformative project known as the Port of Churchill Plus. The project would upgrade it to a year-round multi-commodity hub, connecting Western Canada to the north and the Atlantic through Hudson Bay.
It would mean everything. It would mean everything to get people back to work and have an opportunity for our youth to stay here if they choose and make their living here.
Since the port slowed, tourism has become the main economic driver.
In a given year, we have upwards of 25,000 visitors that come to Churchill.
They're flocking to the polar bear capital of the world for the wildlife and the northern lights. The Chamber of Commerce says any port upgrades would have to strike a balance with the tourism industry.
Churchill has a lot of land-based research. I've had it for many years, and we're also gaining water-based research. And so right now is a great time to put that all together.
Manitoba's premier is set to visit the remote community tomorrow to hear what residents have to say about the port's future, which for right now is still not set in stone. But community leaders say it's time to act.
Diversification is critical, it's key. We can't succeed on just tourism.
Manitoba's premier will touch down on the frozen tundra tomorrow. On the agenda, talking tourism, marine conservation, and a town hall with residents before he plans to play some hockey with the locals. Alison Bamford, CTV News, Churchill.
Up next, the closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the Nasdaq, Microsoft ringing the bell. In New York, Tyler Technologies celebrating its 60th anniversary. In Toronto, TMX Group and Verity leaders are closing the market out. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX moved up another 204 points today, about 0.6% to 32,388. Still well off its high of 33,000 plus last week. The S&P 500 has a 58-point drop. It's down 0.84 of 1%. And the Nasdaq has a 336-point drop today. That's over 1%, almost closer to 1.5%. Let's get to the movers in Toronto. Energy Fuels, a big gainer today. It's up 16% plus, or $4.69 a share. That's on news that Donald Trump says Project Vault will include a strategic uranium reserve. And Energy Fuels has been the leading U.S. producer of natural uranium concentrate for several years. Taseko Mines up today over 13 and close to 14%, taking the share price to $12.02. Ivanhoe Mines also a gainer today. They're in advanced discussion to supply the U.S. with critical minerals, which they know they want. 8.6% move up, $1.48 gain per share. In the red today is Thomson Reuters. They are down almost 16%. That's a 23.59 drop. And that's on an AI disruption scare. We'll get more of that in a moment. And then Shopify also losing today close to 10%, taking shares down $17.44. And over the 1 year, they're actually down almost 4%. Altus Group also down today over 10%, taking the share price to $41.63. And then Descartes down today as well. It's down 9%, taking the share price to $90.43. CGI, another loser on the TSX today. It's down about 0.5% or 25 cents to $48.75. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us to talk some more about what's been going on. Stephanie, a pretty wild day on the markets. Can you expand on what Thomson Reuters does and what that concern was?
Yeah, so Thomson Reuters is basically a data company, and it has a wealth of different services, one of them being legal services, legal software for companies. So that's kind of what lends into the share price falling by nearly 21% at its lowest point today, which was its biggest intraday drop on record, just period. And that's after artificial intelligence firm Anthropic unveiled a new productivity tool that's meant to automate some legal work for certain companies. It also made the company, or Thomson Reuters, the worst performer on the TSX today, as you alluded to, and dragged the stock price to its lowest level since May 2021. So it's given up a few years of gains there. So a couple of analysts are talking about or had a mixed reaction about what this new Anthropic tool actually means for companies, data companies like Thomson Reuters, and how it disrupts the legal software space. Some say it's oversold today. Some say this is an actual valid concern. Starting with Morgan Stanley analyst Tony Kaplan, who said that while Anthropic's new tool is actually pretty similar to others that we see on the market right now, it does signal an intensifying AI competitive environment that puts Thomson Reuters at risk there. So Kaplan added that most of the investors that they've spoken to are overwhelmingly bearish on Thomson Reuters, pretty much for this reason. They're concerned that Thomson Reuters might not be able to maintain the growth levels in its legal segment because of this heightened competition, and this tool just kind of intensifies those risks there. Now, that being said, I also heard from analysts like Douglas Arthur from Huber Research, who said that it's an overreaction. The markets will sell first, ask questions later. Said that it's not like a bunch of legal firms are actually just going to get rid of Thomson Reuters as a software and just jump to this new software automatically. But that being said, this downfall or this drop in prices that we're seeing today is contributing to some pressure that Thomson Reuters has been seeing over the past year, down by over 50% over the past year. Last time I checked, part of it due to the AI disruption and the second quarter profit miss. So it's been a rough go for Thomson Reuters today, Marella.
Okay, let's get to Tech Resources. They're gaining on the bounce back of metals.
That's right. Yeah, Tech Resources gained by about 9% today. That's its biggest intraday leg upward since September. So Tech Resources mines a few different metals, including copper, gold, obviously a few others, but it's gaining on the fact that copper is paring its losses after a heavy trading sell-off session during Asian trading hours. But you saw some buyers in the Chinese market jumping in, buying copper at lower prices. So that's giving the metal and thereby Tech Resources a bit of lift there. On top of that, we also saw gold rebounding as dip buyers are returning to the market, seeing gold at a lower price point. They're trying to get more exposure to precious metals after a crazy runoff, but it did kind of reverse some of those gains starting on the Friday trading session. So there was a multi-day rout that kind of snapped that streak today. And there are a few other metals companies on the TSX that are gaining in tandem with tech, including Aya Gold and Silver, Aris Mining, and a few others, Marella.
All right, Bloomberg, Stephanie Hughes with the update out of Toronto. Stephanie, thanks for that. Let's move south of the border and get some of the movers there with Bloomberg senior equities reporter Bailey Lipschutz. Bailey, the first company we're talking about is a healthcare service company, and the stock moved by double digits today on a beat. Can you expand on what happened?
Yeah, DaVita is a company that operates in the kidney dialysis space. And when you look at today's huge move, the biggest rally for the company since 2000. It was really driven by modest expectations. This is a company that still is down about 25% in the last 12 months, so low bar to clear, but management clearly exceeding that. As you can see, a big rally today after boosting and kind of providing a 2026 outlook that was better than maybe Wall Street was hoping for, Wall Street was fearing. Obviously, when stocks are beaten down like this, you do have the risks of short selling and a potential short squeeze to the upside, so that could have been a factor at play. So all things considered, a positive readout from DaVita, kind of leaning into their ability to kind of at least embrace their mode around that kidney dialysis business. But this is, again, still a company that's under quite a bit of pressure, as you can see, not only over the last 12 months, but even if you step back further than that. So a big move, the best performer in the S&P 500, at least the last time I checked, but still not necessarily recouping many of those losses, just getting back to where it was in the fall.
Yeah, 23% down over the year. Okay, let's get to Palantir, which reported earnings. Lots of people talking about it. They did really well. How much did shares improve?
Yeah, a strong move higher for Palantir. Was up at one point. One of the best performers of the S&P 500 came back in quite a bit as kind of the broader sell-off we saw, but nonetheless, really strong move in a day that was choppy, as you can see, beating expectations on revenue. CEO Alex Karp talking about how they exceeded even their most optimistic expectations internally. Wall Street really pounding the table that this is one of the AI software companies that can win in an AI world. Obviously, we've talked ad nauseum about the sell-off for software stocks in the wake of the latest update from Anthropic's Claude, but this does seem to still be a world that Palantir can win in and execute in. As you can see, though, still not quite where it was back in early October, but a big win for some of the market bulls nonetheless.
Let's get to PayPal, which is changing course with a new CEO. What happened?
Yeah, this is a tough story when you look at the company closing at, I believe, the lowest level since 2017, missing expectations. As you mentioned, it's never good news when you have to replace a CEO. Reading through some of the management talk, a needed change as they're trying to right the ship and steer the company back to what it once was. Again, this is an ugly 12-month chart. If you look back to where it was back in 2021, it's even uglier. It does not seem like the company has been able to right the ship how they had been expecting. When you bring in a new CEO, potentially resetting expectations. These are always closely watched, especially when you look at kind of what the forward guidance will look like, what management commentary will look like with the new CEO in the seat, and give new management a couple months, if not a couple quarters, to really try to lay out their vision. So we do tend to see investors not only punish misses to the downside, not only punishing stocks that are underperforming in the last 12 months so far in 2026, but now you have to deal with potentially resetting the bar. And that was another reason that, at least when I talked to a few investors, they were more than happy to part ways with some of their stake in PayPal.
Got it. Bloomberg's Bailey Lipschultz, thanks for the update. Coming up next, markets pulled back today. Investors rotated out of technology stocks. Only the TSX moved up. Back in a moment. Markets were mixed today. The Nasdaq leading the losses as investors sold shares in tech-related names. Let's go to Keith Buchanan on the senior portfolio manager at Globalt Investments. Keith, NVIDIA CEO says no bad blood between his company and OpenAI, but you have concerns about. Do you have more concerns about that deal or others like it?
Sure, and thanks again for having me. We've looked at this deal, as well as the entire group, as having this circular nature that was concerning to us when some of these deals were talked about 12, even 18 months ago. The nature of these deals kind of brings along a risk that we feel like the market wasn't really grasping, in that the dominoes are put much closer together as we have a lot of overlapping funding mechanisms and also optimism that one deal that's actually moved south of 20 or 25% really doesn't affect the entire secular opportunity, but it could affect the valuation of these names and these stories in the very near term. That was a concern that we had several months ago, as I mentioned, and it's one that still persists today.
All right. What else did you see dragging the North American markets down today?
Sure, we've been moving into this into 2026 and finishing the first month with a lot of concerns of just how the market at least moves forward over the next quarter or so. from an earnings standpoint, we feel like the bar has moved ever higher. And in fourth quarter that we're reporting now, expectations coming into the quarter were 8% growth. Now we're north of that. Now we're closer to 12% growth. And as that bar moves higher, good just isn't good enough. Fair just doesn't cut it. And the market is now expecting great earnings results. And that actually accelerates those expectations accelerate over the course of 2026. So we feel like the bar is moving significantly higher. And the market's now focused on more than just revenue growth from an interesting or attractive story. We're also looking now at cash flow generation, margin resilience, some of the quality metrics that we feel like kind of indicates where we are in the cycle. So we feel like this earnings season it poses a lot of opportunity, of course, but also challenges come with that, with expectations moving as high as they have over the past couple of quarters.
Meta and Microsoft, as you know, reported one went up, the other went down. Is that return on investment for AI still what investors are very hyper-focused on?
Sure. We feel like the market is differentiating between the picks and shovels of the AI story to those longer dated payoffs that have more upside in the outer years. And in that spectrum, of course, corporations lie anywhere along that spectrum. But I think the key factor in how the market has shifted over the past month or so is understanding the funding mechanisms that takes you from one point to the next along that spectrum. And that's what the market is really starting to digest. We feel like it's a healthy exercise. The market is dissecting and discerning between stories that have cheaper, more immediate funding mechanisms that aren't related to the story next to it. But as we go through this process of unwinding each one of these stories and making sure the cash flow generation prospects that are baked into some of these names over the coming years really have the sustainability as we move along that spectrum again to realizing some of these gains of the first phase of this AI infrastructure build out to move into those later phases of those longer dated payoffs that we see the market really valuing fairly highly in this part of the cycle.
Okay, as investors are going through that, what matters now? Where is that storyline shifting to and shifting away from?
Right. We see the storyline as kind of aligning with what the broader market is really valuing, and that's quality, cash flow generation, and margin stability. If those stories don't start to demonstrate that in a very material way, especially again, some of the overlapping nature of the deals that have been struck and some of the optimism that's baked into these names as far as a revenue standpoint, the valuations can continue to start to drain into other spaces that can demonstrate that quality and cash flow generation outside of the AI-centric and adjacent spaces to even outside of tech into more old economy names that we've seen perk up a lot over the last month and a half. So that's what we're really seeing develop. We've seen some of that attention move outside of the space of tech in a very, again, not necessarily disorderly or unhealthy way, but it presents new challenges to the tech story that we have to see fulfilled in execution on a quarter-to-quarter basis.
All right, let's talk to a couple of stocks that you actually are looking at these days. One of them is Gap. What do you like about Gap?
Right. The turnaround story, in our opinion, is really significantly underway. We've seen some of the merchandising improve. Cost controls have become really more in focus. Q1 really demonstrated that, and we see that starting to continue into as we get further in 2026. And upside to expectations, we feel like is really underway and not necessarily priced into this stock. We feel like it's priced like a broken retailer story. And some of the execution that they've been able to demonstrate over the last couple of quarters really hasn't started to be priced in to push forward forward valuations into 2026. So we feel like that's an opportunity to buy the shares here. And we've been really optimistic about the offering kind of going into 2026.
Okay, let's get to your next pick, which is Goldman Sachs. And why are you liking Goldman Sachs compared to the others?
Sure, a completely different story than Gap, of course. But it's a pure play cap markets story right now that they demonstrate in the first quarter robust earnings power as we kind of, and as well as some of the bulge bracket names as far as some of the ancillary businesses they own that Goldman is a front runner as far as setting a standard in some of those cap markets businesses. We really see that developing over the course of 26 to have valuation that coalesces around Goldman Sachs's revenue streams. And we don't feel like that's necessarily under threat if we don't have the acceleration of Fed rate cuts like what is driving some of the valuations outside of cap markets within the financials industry. So we feel like it's a really attractive, pure play, if you will, and of course, very quality management team and opportunity set that really benefits this name in 2026.
Okay, Keith Buchanan, got to leave it there. Thanks for your time. Appreciate it.
Thank you.
We want to bring you some earnings right now coming from Chipotle Mexican Grill, CMG in New York. Here are fourth quarter results. Comparable sales down 2.5% versus up 5.4% year over year. The estimate had been greater, that it would be down closer to 3%, so 2.94. Adjusted earnings per share for Chipotle coming in at 25 cents versus 25 cents year over year. So the estimate had been 24 cents, so a little bit of a beat there. Revenue coming in at $2.98 billion. That's up almost 5% year over year. The estimate had been at $2.96 billion, so a little bit of a beat there for them as well. New restaurants, 132. The estimate had been 126. And the average restaurant sales, 3.1 million. That's down 3.4% year over year. The estimate had been 3.04. So a bit of a beat there on the average restaurant sales. Here's the forecast for the year. Sales at established locations are expected to be about flat. The estimate was plus 1.84. That was Bloomberg consensus. And Chipotle says new locations will help to fuel growth, with plans to open 350 to 370 new stores next year. Chipotle is also looking and concentrating on their drive-through lanes designed for picking up their mobile and digital orders. So we'll get into more of the turnaround plan for the company, dubbed Recipe for Growth, later in the show. And coming up next, Advanced Micro Devices reporting earnings as well. How do they stack up with competitors? We'll get into it in a moment. We have earnings results coming in from Advanced Micro Devices, AMD, on the NASDAQ. Fourth quarter results as follows. Adjusted earnings per share coming in at $1.53 versus $1.09, so that's year over year. The estimate had been at $1.32, so a beat for AMD there. Revenue coming in at $10.27 billion. That is up 34% year over year. And the estimate had been $9.65 billion, so a very big beat for them on revenue. Let's break it down. Data center revenue coming in at $5.38 billion. Again, 39% up year over year. The estimate had been $4.97. Gaming revenue coming in at $843 million, but that's a 50% increase over year. The estimate had been $855. So it's actually a miss on gaming revenue for them, even though it's 50% up. Capital expenditure, closely watched these days, $222 million, so up 6.7% year over year. The estimate had been $231, so less expenditure there. R&D expenses at $2.33 billion, up 36% year over year. Estimate had been $2.16. And the forecast for the first quarter. Revenue they see coming in at $9.5 billion to $10.1. The estimate in between at $9.39 billion, which is coming from Bloomberg. Adjusted gross margins about 55%, and the estimate had been 54.5. Okay, let's break this down with Romeo Alvarez. He's Director Research Analyst at William O'Neill & Co. Thanks for joining us today.
Thank you for having me.
This company does many different things. So what's the key metric for you?
The key metric is the data center revenues, that is what's driving growth for the company. And that's what basically all the analysts, the market is focusing on at this point.
Okay, so they beat on that. The estimate had been under $5 billion. They came in at $5.38 billion. How big of a beat would you qualify this as?
I think it's a very solid beat. It's definitely not the best I've seen within the industry this quarter, but I think it would be enough to justify where the stock is trading and for a potential move higher. I see the stock down in after hours, so maybe some had higher expectations, but all in all, I do think this is a pretty good result for AMD, and the company's beating across all the numbers, whether we're talking about the December quarter or the March estimates in terms of revenues, EPS, and margins. So solid quarter overall.
You can see, as you mentioned, stock down at about 3% to 234 right now. What is the biggest challenge for this company? I know it aims to rival NVIDIA, but what would you say its biggest challenge is in trying to do that?
I think the biggest issue is beating NVIDIA's ecosystem. So AMD, I believe, will have the competitive hardware. They have a new series coming out in the second half of this year, the MI455. But on the ecosystem as a whole, which includes the software, I think that's when NVIDIA still keeps the lead. They have all the main customers. They have the market share. So it's not going to be easy for AMD to take a big portion of that market. I think a bigger issue, and maybe why the stock could be reacting negatively after hours, is the customers. So not the competition itself, because if you look at NVIDIA, it was also down today during regular trading hours. I think it's looking at what OpenAI is doing, Oracle is doing, Microsoft is doing, and all these companies are under heavy scrutiny and heavy pressure due to the high CapEx needs and the financing that requires.
You talked about the competition. Does Intel provide real competition for this country? And they're being affected by manufacturing problems. Does AMD face any of that?
I would want to listen to the conference call to see if they say anything on that front. Intel did admit that they are having constraints when it comes to supply chain on the CPU side, and that's where they compete with Intel. On the AI or GPU side, that's where they're competing with NVIDIA. As of right now, we have not heard about any constraints, supply chain constraints regarding AMD, but I would still want to listen to the conference call to make a statement there.
Okay, have they been able to find new customers? You mentioned that the ecosystem for NVIDIA makes it hard for them to do that. Have they been able to drum up something new?
So the big game changer happened last October when they announced OpenAI as a new customer. And that was a big endorsement in my part, and we saw the stock break into new all-time highs. Since then, the stock has been in a nice uptrend. But I think going forward, I think investors want to see more, like what's next. They want, because relying on one big customer, it's still a risk. So I think the market is probably going to be looking for companies like maybe Meta, Amazon, Google, and others, which I mean, it's not definitely easy because there's also the route of companies developing their own chips, like Google with the TPUs. So there is definitely heavy competition there, and that could also be a drag on the stock near term.
You mentioned a look ahead to March, their first quarter forecast, which is 9.5 to 10.1 billion. The estimate had landed in between. What are your thoughts on what they are expecting in the next quarter?
So I believe the big growth will happen in the second half of the year once the new chips, the MI455, is deployed. Near term, I think these numbers are actually pretty good. I mean, they beat on the revenue guidance, which is what we have so far. You know, the numbers just came out. So I'm very happy with the results so far. And I think the biggest catalyst, again, will happen in the second half. And I think that's when you're going to see the growth really accelerate.
Okay, let's leave it there. Romeo Alvarez is Director Research Analyst at William O'Neill & Co. Thanks for that. Coming up next, the largest merger in history announced yesterday. Elon Musk's rocket company, SpaceX, acquiring his artificial intelligence startup, xAI, and a deal valued over $1 trillion. We'll talk about it in a moment. SpaceX has acquired xAI, bringing Elon Musk's rocket and artificial intelligence companies together. Musk says the merger creates a $1 trillion company. Let's go to Jay Bala, CEO at AIP Asset Management, for some more insight. Jay, you've been invested in both SpaceX and xAI for some time. What is your take on the merger?
No, look, I mean, I think it's a great opportunity. I think it's going to be good for investors in general. And we've talked about this before, that, you know, the private markets is a market that investors need to take a serious look at. It's becoming a dominant force in the investment universe. Today we've got over 1,200 companies or 1,200 unicorns in the world. You've got, about a combined 5 or 6 trillion AUM business there. And so, if investors aren't invested in pre-IPO companies, or, if you're sitting with your advisor and, you're looking at your portfolio and you don't have any exposure to pre-IPO companies, look, I think it's going to be a fair question to ask, why not? Why aren't we looking at this space? And, I think the merger of SpaceX and xAI creating the world's largest company, it wasn't born in a vacuum, right? Like, this has been happening for many, many years now, where you've seen, a significant amount of capital go into that world, whether that's through private equity, private debt, venture capital. So look, I realize the valuations look staggering, but this is no surprise to us. This is the first of many companies like this to come out of that space. And, I think over the next kind of 12 months, you're going to see companies like OpenAI and Anthropic also come, with these sort of mind-boggling numbers, right? I grew up in a world where, $1 billion was a lot. Now, we're looking at trillions, right? Which is a whole different number.
Okay, so this is ahead of, we talked about a planned IPO. What's the benefit for the IPO putting these companies together?
Yeah, look, if you think about it, he's bringing 2 technologies together. One is effectively the space launch capability, and the other one is through xAI. It's really that AI technology and the data warehouse, and then the data centers. And the whole idea being, he wants to create, or Elon Musk wants to create, these orbital data centers. And the idea being, it's going to be much cheaper from an energy perspective because you can use solar energy and other kinds of energy to power that. And so, look, obviously, it takes a very significant amount of capital to build all of this out. And so, look, I think obviously accessing the capital markets at this range with that kind of valuation is obviously beneficial to the company and to him, right?
Okay, so we're hearing a lot more about data centers in space. What do you think about the idea? You mentioned how much investment it would take. Clearly, it would take time, but the energy would be right there. What do you think about the idea?
At the end of the day, it's obviously groundbreaking, right? Like, meaning it comes with an incredible amount of potential, but it comes with an incredible amount of risk. And so, look, at the end of the day, that's the investment universe, right? People have to make that decision on thinking, well, are we going to do it in a measured way where you kind of build a small data center and then see if you can scale that and build that and grow that? And I think that's kind of the approach they'll be taking. So, I realize it sounds out there, but I think it's well worth the try. And if it works, it's going to work out incredibly well, right?
Yeah, he's got the money to do it. What about Tesla? Does this leave Tesla sort of stranded on its own?
If you look at the history of his companies, they're always intertwined, they're always intermingled, they're always doing investments through one another. And I think his investor base is a very strong, sort of loyal investor base. And so they're used to that. And so, I don't think Tesla's going to be abandoned in any way. If anything, I think you're going to see more and more transactions between Tesla and, new SpaceX.
But you don't think they'll come under one umbrella at any point?
You never know, right? At the end of the day, I think, we'll see. Part of it is, I think if you merge them all, maybe that market cap becomes too big, right?
Well, 1.25 trillion is already pretty much out there, so.
Exactly.
Yeah, okay. Jay Ballot, got to leave it there. Thanks for joining us. Appreciate it.
Pleasure.
Up next, Chipotle sales outlook falling short of estimates. We'll get into the challenges of that food business when we come back. We have fourth quarter results from Chipotle. They sent the information out after the end of the trading day. Investors, however, not really impressed. Full year sales outlook falling short. Let's go to Jim Solera, research analyst of institutional equities and research. He joins us now to talk some more about this. Thanks for joining us today.
Thank you.
Okay, so we know Chipotle is facing some challenges. I'm wondering if the challenges they're facing, which is a consumer who doesn't have a lot of pocket cash, is industry-wide. Are other companies like Chipotle facing that same problem?
Yes, I think the challenges faced Chipotle specifically in the restaurant industry more broadly can really be put into two buckets. One, like you mentioned, headwinds from higher prices, consumer, particularly middle and lower income consumer, feeling some of that pressure, but also from increased adoption of these GLP-1 drugs and what that does to overall restaurant consumption. If you think, people that are on the drugs, range of estimates, but typically lands around 20% reduction in calories. That obviously is going to come both out of meals at home and restaurant meals. And so what we've seen across the restaurant industry as a whole is kind of modestly low single digit down traffic in 2025. I think the hope with Chipotle is that after a down year in 25, we would start to see a reacceleration in 26. And the company's, guidance for flat same-store sales in 2026, I think, throws a little bit of cold water on that. And so it's not quite clear when we're going to start to see the impact of those kind of dual headwinds, the pricing headwinds, and then the GLP-1 headwinds, when those will start to ease.
Yeah, it's amazing to me how much those drugs have had an effect on companies like these ones, with people not sort of going to fast food or not ordering maybe as much when they do. On the first point about not enough money for the lower consumer, I'm wondering if they have taken that bull by the horns. We know McDonald's and other companies said, okay, our menu, our meal deals are going to be, $5 or $10 or whatever it is. They've actually brought prices down for some of their products. Is Chipotle doing the same?
Yeah, so you've seen some menu innovation with Chipotle. They've been, very prominent about going back and making sure that all the restaurants are giving the appropriate portion sizes. We've seen kind of the discussion around, do you get more if you go in the restaurant versus order through one of the third parties, like Uber Eats or DoorDash. But then also, having smaller menu item options. So their protein menu has been something that they've highlighted and put a lot of, marketing support behind. At the same time, it's sort of happening across all of restaurants. You see a lot of restaurants taking prices down. And so it does broaden the consumer choice a little bit, where if you only have one restaurant that's reducing prices and everyone else holding still, that kind of shifts traffic there. And so I think Chipotle is certainly playing, they have part of that as a component. But remember, if pricing in the past was a benefit and we're going to start to see them, maybe pricing be a modest headwind, then that's going to weigh on same-store sales if you assume your traffic numbers are kind of, flat to down modestly. And so I think that's going to be the key component and what we're going to be looking for as the company gets into detail on the call here is what's the pathway to get back to, consistently positive traffic and bringing new guests into the restaurants.
Yeah, they're betting very heavily on opening new locations. They have an ambitious plan ahead on that. Is it the right time, do you think, for the company to continue to open restaurants considering the climate?
Yeah, so I think when they look at new restaurant locations, obviously Chipotle is very much U.S. centric. I think they're looking at a lot of opportunity, international markets, Europe, the Middle East, areas where they can go into market with existing partners in those areas that have a lot of depth of experience operating restaurants in those different markets. I think you've seen that as a playbook for a lot of restaurants that have success in the U.S., but also have a very prominent brand that they can borrow that brand equity and use it to kind of jumpstart in a new area. So I think that certainly is a worthwhile, growth vector for them. However, given the overwhelming size, they have almost 4,000 restaurants in the U.S., that is obviously going to be driver of the stock performance over the next, year plus. And so I think to make the stock work, we're going to really need to see a list or, a selection of what they're going to do domestically to get that traffic back and to get people, re-engaging with the brand and coming back to the restaurants here.
Okay, one of the other things we're doing are these lanes, like pickup lanes, essentially, where you can pick up something you've ordered digitally. Is that working for them?
Yeah, I think, Chipotle has put a lot of emphasis on throughput, and so speed of service. I think when you have a lot of people, coming out of COVID, there was a step up as everyone, went back to kind of their normal behavior post-COVID. People had extra money in their pocket. They wanted to go out to restaurants. They wanted to, go to their favorite restaurant. And I think in a lot of cases, some of the restaurants were constrained by operational limits and not being able to service, especially during peak demand times. Their investments in throughput have uncorked some of those bottlenecks. And so I think in a normal environment, a lot of the things they've done, with the Chipotle lanes, with increasing convenience, with lessening the burden on the in-store staff, servicing the people coming into the restaurant, have all done well. But now that we've introduced this kind of second headwind that the industry has to deal with GLP-1s, all of a sudden the focus shifts from how do I service increasing demand at my restaurants to how do I generate increasing demand for the restaurants. And I think the solutions to those are very different. And so I think the company is going to switch their focus to really honing in on what type of menu innovation do we need to do, what type of messaging do we need to do, what type of price points do we need to have in order to get guests to engage and make us stand out in a industry where you're probably going to see less overall restaurant meals consumed.
Got it. Jim Solera, thanks for joining us. Got to leave it there.
Great. Thank you.
After a closely watched succession race in the Mouse House, Disney has named its new CEO. Back in a moment. Disney has named Josh D'Amaro, current chairman of Disney Experiences, as the next CEO, so he will succeed Bob Iger. Now, he'll take the job on March 18th. Disney's chairman, James Gorman, joined our Bloomberg colleagues to discuss the decision.
He's a fantastic executive. He's strategic. He's run a huge operations, one which Disney is now investing $60 billion of capital into. He has great creative instincts. He has what Bob Iger calls exceptional taste. He's a leader who's operated all over the globe, including the recent expansion that's going to happen in the UAE, which he did with Bob. He's the person for this time. So Josh is just a standout executive. We looked all over the world, as you could imagine. We wanted to do this right. We wanted to make sure that whoever got the job beat all comers, and he beat all comers. So we're thrilled.
Mr. Gorman, what mandatory goals, performance targets did you set Mr. D'Amaro over the term of his contract?
Well, we haven't set goals in terms of his contract. He hasn't started. He'll be taking over as CEO at the annual meeting, which is March 18. Bob will be working with him through 2026, guiding and mentoring and helping further develop him. Obviously, he laid out a vision for the board in the various discussions we had, which we had numerous ones. We really got to know Josh and all the other top executives, Dana Walden, Alan Bergman, Jimmy Pitaro, just a tremendous group of 4 executives we had to consider in this process. And, over time, we'll work with him as he settles into the job to lay out what the right strategic moves will be and how we're going to measure ourselves against those. So I'm highly confident in Josh and the team working with him.
Mr. Gorman, there was reporting that Mr. Iger confided in those close to him that he wanted to leave Disney before the end of his contracted term. To what extent did that push the board to move up its succession timeline?
Yeah, I think firstly, let's just talk about Bob. I mean, he's had effectively 2 careers at Disney. The first was an amazing 15-year run where he did deals that, nobody else on the planet could have done, frankly. He worked with Steve Jobs, with George Lucas, with Rupert Murdoch to buy a bunch of studios, which we now oversee 7 studios, which Alan Bergman has been overseeing. By the way, produced under Alan's leadership and working with Dana, and has produced over $6 billion movies in the last 2 years. But Bob did a phenomenal job. When the company got in trouble, and it was before I joined the board, they invited Bob to come back. And really, there were two mandates for him. One was to get us through the very difficult post-COVID period and the changes taking place in the linear space with what was going on in streaming and now what is going on in AI. He did that. He really got the company fit for purpose. The second was to make sure if we were to go internal, that the lead executives, and we had 4 of them to consider, would be ready for prime time if and when we went in that direction. We ultimately did. So Bob came to us a little while ago and said, they're ready. I mean, Josh is ready. He's ready to take over. If the board's will is to move on this, I want to step aside and I want to work with Josh as a senior advisor, stay on the board through the end of the year. It's not about the length of the contract that he was under. It's about his role as CEO and then as mentor for the next CEO. So hats off to Bob. It was very selfless, and frankly, it's what's great for the company.
Did you consider Bob Iger continuing on in a co-chairman capacity or a chairman emeritus type role? I appreciate that there is an advisor agreement here, but does that have a definitive end?
Yeah, Bob will stay as an employee advisor and board member until the end of 2026, and then he'll step off the board. He won't be an employee. He'll continue to consult to the company, consistent with what former executives do. I'm doing that at my former institution, Morgan Stanley. But no, we were not, Bob was not interested in remaining as a chair or co-chair. We needed a completely clean start here, which is what we're having. He'll be there to support and mentor, and we have the right structure for the future. So we're thrilled. And, you look at what's going on now that we've appointed Dana also as president and a new role, chief creative officer. That's to ensure that the leadership team at the heart of this company is creativity and storytelling. And it's to ensure the leadership team brings their absolute best every day, leveraging our IP, telling stories across all of our properties, whether it's cruises or parks, our TV, our ESPN platform, and obviously the studios. Right. So we're really set. We're set for the next decade. I'm very excited about it.
Mr. Gorman, ultimately, you went with Josh D'Amaro for the CEO role. In promoting Dana Walden to the CCO president hybrid role, how conscious were you of keeping her, giving her that title to ensure she stays at Disney long term?
Oh, my goodness. If you don't want to keep talented executives, there's something wrong with you. We had an embarrassment of riches. We have, as I said, Jimmy Pitaro, who's run ESPN, is a fabulous executive. Alan Bergman, who's run our studios businesses at 7 studios, has done an unbelievable job. Dana, obviously, incredible executive with a long history in Hollywood, in the industry. And Josh, we wanted to keep all of them, and I believe we will. I mean, I think this is a win-win for everybody. And I couldn't be more excited about it. So yeah, absolutely. If you have talent, you want to keep them. Finding talent, developing talent is really hard. So when you got it, you do what you can to retain it.
Well, Mr. Gorman, it seemed like a 4-way playoff, right, of internal candidates. In that vein, how concerned or otherwise were you about keeping Jimmy Pitaro and Alan Bergman at Disney long term too?
Well, it was more than 4 ways. We really approached this, and when I say we, the board, we had a succession planning committee, and I was honored to serve with Calvin McDonald, Sir Jeremy Darroch, and Mary Barra, who were the succession planning committee. Then we quickly moved to full board engagement, and each of the other directors played a meaningful role in this, and I couldn't be more grateful for what they did. But, we decided early on we wanted to look at all comers. We had a list, my goodness, it must have been over 100 people initially that we thought about, we considered, we evaluated. We ended up talking to several executives outside the company because I wanted to be sure, we all wanted to be sure that whoever got this job got it on their merits. They had beaten anything that was presented from the marketplace, and we had the best possible candidate. So that included external, it included internal, it included the 4 that you talked about. And I think all of them are very important to this company, and we're honored to have them in critical roles.
Yeah, that was about the Disney's new CEO. Thanks for joining us today on The Close. We'll see you back here again tomorrow.